Welcome to The Explainer. Today, we are jumping right into a really fascinating story unfolding in the healthcare sector, straight out of HCA Healthcare's second quarter 2026 earnings report. If you want to understand the current state of the healthcare economy, you absolutely have to look at this quarter because, well, it's basically the ultimate financial tug-of-war. On one side, you've got these significant operational headwinds really testing the company's resilience. But then, on the exact opposite side, we're seeing massive, almost perfectly timed tailwinds pulling them right back to equilibrium. It's a true financial balancing act, and we're going to break down exactly how it all played out. Now, to really appreciate the stakes here, we first need to establish the sheer scale of HCA Healthcare's operations. We are not talking about some small regional player. We're talking about a massive network that operates 190 hospitals and roughly 2,600 ambulatory care sites. That includes your surgery centers, freestanding ERs, urgent care clinics, and physician practices spread across 19 states and the UK. So when a company with this kind of massive footprint reports its numbers, we aren't just looking at a corporate ledger. We're getting a real-time pulse on the broader healthcare landscape.
Okay, let's dive into this. Here is our roadmap for today. We'll cover the Q2 top-line results, navigating the payer shift, the Florida Medicaid boost, patient volume trends, capital and shareholder returns, and finally, their revised 2026 guidance.
Kicking things off with Section 1, the Q2 top-line results. Despite the tug-of-war happening behind the scenes, HCA's top-level numbers actually showed remarkable strength. Here is the first massive figure to anchor us: $20.23 billion. That is HCA's total revenue for the second quarter of 2026 alone. To put that into perspective, that's a really strong 8.7% increase compared to the exact same quarter back in 2025. That kind of top-line growth, it's a clear indicator that the overall demand for their services and their capacity to generate revenue remains incredibly robust. And you know what? That revenue translated really nicely into profitability. Net income attributable to HCA reached $1.699 billion for the quarter, which is a 2.8% increase year over year. Diluted earnings per share jumped over 11% to $7.62. Plus, when we look at adjusted EBITDA, which is a super key metric for operational profitability, that grew by 4.6% to hit $4.027 billion. So on the surface, the engine is humming beautifully. But to understand the real story of this quarter, we've got to look under the hood. Moving on to Section 2, navigating the payer shift. So this is where we start to actually see the friction in that tug-of-war. To understand the primary headwind hitting their bottom line, we really need to understand what a payer mix shift is. In hospital finance, your payer mix is simply the proportion of your patients covered by different types of insurance, like commercial, Medicare, or Medicaid, versus those who are completely uninsured. In Q2, HCA experienced a shift driven specifically by an increase in uninsured volume. What this means in human terms is that real people are losing their coverage on health insurance exchanges. And when those uninsured individuals walk through the hospital's doors, it directly impacts the hospital's financial predictability and ultimately their revenue realization. And the financial toll of this specific payer mix shift? It was heavy. HCA estimates this shift had an unfavorable impact on income before taxes of approximately $400 million during just the second quarter alone. Now, it is worth noting that this $400 million figure actually includes a $75 million hit related to an adjustment from their previous first quarter estimate. And compounding this insurance headwind, they also noted a secondary operational headwind. They saw a service mix shift, primarily related to a decline in their surgical volume. So you have more uninsured patients and fewer high-margin surgeries. Honestly, that's a pretty tough combination to deal with. Which brings us to Section 3, the Florida Medicaid boost. Now, what's really interesting here is the balancing act I mentioned earlier. On one side, we have that massive $400 million unfavorable hit from the payer mix shift. But look at the other side. During the exact same quarter, HCA recognized approximately $400 million of incremental net benefit from Medicaid supplemental payment programs. This was heavily driven by a newly approved state-directed payment program in Florida, which was greenlit by the Centers for Medicare and Medicaid Services. So think about that. You have a massive unexpected cost on one side of the ledger, being almost entirely neutralized by a massive influx of supplemental Medicaid funds on the other. It is a stunning real-world example of how diversified revenue streams and public policy can intercept to completely stabilize a healthcare giant. Let's shift gears a bit to Section 4, patient volume and trends. Stepping away from all the insurance paperwork for a second, the actual patient foot traffic paints a fascinating, kind of mixed picture. General facility traffic is definitely up. Same facility admissions grew by 2.5%, and ER visits jumped by a very healthy 3.6% compared to the prior year. However, contrasting with that general volume growth is a decline in complex procedures. Inpatient surgeries actually dropped by 2.3%, and outpatient surgeries fell by 3.4%. Yet here is the kicker. Despite doing fewer of these traditionally lucrative surgeries, HCA's revenue per equivalent admission actually rose by 6.4%. This tells us they are managing to extract more value and optimize their pricing and care models, even as the specific types of care they're providing are shifting. Moving right into Section 5, Capital and Shareholder Returns. As you can imagine, managing a balance sheet of this size requires some serious cash generation. In Q2, their operating cash flow came in at a robust $2.335 billion, and they are putting that cash to work directly for their investors. During the second quarter, HCA repurchased 4.752 million shares of its common stock at a total cost of $2.064 billion. Buying back over $2 billion in stock in a single quarter, that is a massive signal of financial confidence from the management team. And what's even more impressive is that they still have a staggering $7.21 billion remaining under their current share repurchase authorization. In addition to those heavy buybacks, HCA's board of directors also declared a quarterly cash dividend of 78 cents per share, which will be payable to stockholders in September of 2026. Between those multi-billion-dollar buybacks and the steady dividend payouts, these numbers really confirm that HCA's underlying cash position remains exceptionally strong. It's allowing them to navigate all this industry turbulence without sacrificing shareholder returns. And finally, Section 6, Revised 2026 Guidance. So the crucial point is, what does all this mean for the horizon? While revenue guidance shifted slightly to a range of $77 to $79.5 billion, the impact of that Q2 turbulence is super evident in their other metrics. They actually lowered their full-year net income forecast to a range of $6.3 to $6.7 billion. Why? Because they significantly worsened their estimate for the health insurance exchange penalty. They are now projecting a massive $1 billion to $1.2 billion unfavorable impact for the year. But, keeping with the theme of the quarter, they also bumped up their estimated benefit from Medicaid supplemental programs to a range of $300 to $500 million. So they are formally baking this ongoing tug-of-war right into their yearly expectations. Of course, management is keeping a very close eye on the broader macroeconomic risks that could upset this balance. In their forward-looking statements, they explicitly called out general inflation and the impact of trade policies and tariffs as potential disruptors to their supply chains and operating costs. But perhaps most critically, they are actively monitoring the looming expiration of the enhanced premium tax credits at the end of 2025. These are the exact credits that help individuals purchase insurance on the federal and state exchanges. If those expire, well, the uninsured rate could climb even further, which would severely intensify the very payer mix shift headwind we discussed earlier. Which leaves us with this final thought. HCA Healthcare proved in Q2 2026 that their sheer scale and diversified income streams allow them to perfectly balance a $400 million hit with a $400 million legislative boost. But as we look toward the expiration of those enhanced premium tax credits and shifting macro policies, the big question remains. As these systemic safety nets begin to fade, can healthcare giants really continue to maintain this delicate financial balance, or will the underlying costs eventually tip the scales? It is a crucial trend we absolutely have to keep tracking. Thank you so much for joining me for this explainer, and keep your eyes on the data.